Today we're taking a look at the giant company Amazon. I'll show you the fundamentals of this company and also provide you with a price target based on my assumptions about the future. I'll also use analyst assumptions to generate a price target. Amazon is a $1.6 trillion company. Just remember, the bigger the company, the less potential growth there is. It just gets harder to grow a company as it gets bigger. Amazon has always traded at a high price to earnings. Over the past 5 years, Amazon has had an average 104 times price to earnings. That is an insanely high price to earnings ratio, especially for a company this size, because you have to think about the price to earnings. That means the market cap divided by their earnings. And what this means, the higher the price to earnings you have, the more growth expected you have in the future. You're basically paying a premium. You're getting less for your money with the expectation of hopefully getting some more in the future. The deal with Amazon is that it is a huge company. It's a $1.6 trillion company, but it still trades at a 50 price to earnings. That is absolutely unheard of. That is able to do that. People are pricing huge growth into the stock price at the moment. A little bit later, I'll use the stock analyzer tool here in the amazing Everything Money software to show you, to put in assumptions about the growth. I'll use historical data, I'll use analyst assumptions, and then come up with a reasonable price for Amazon. But the thing is, if we go ahead and look here, they actually have an insane revenue. So last year they did $469 billion in revenue. So their price to sales is actually reasonably low, very low actually. Price to sales, that is their market cap divided by their revenue. Why is there such a big difference? Well, that is the profit margin. So they have a very low profit margin, and that is why the price to earnings differs so much from the price to sales. When you think of Amazon, you might just think of the website Amazon where you can buy all sorts of things, but there's actually a lot of parts to this business. They have AWS, which is Amazon Web Services, and under that business they have a lot of other businesses, which is their cloud business, and they also have this streaming service like Netflix and Disney, Amazon Prime Video. They have Amazon Kindle. They have, you know, all sorts of. They have the affiliate program. They have so many sub businesses underneath, and really what they've seen the most growth in is this Amazon Web Services that has been growing incredibly fast. And because that is online, that is cloud-based, storage and stuff like that, that has a lot higher profit margin than what they're currently making their money on. What investors are betting on is this profit margin increasing, because right now they have $500 billion in sales, in revenue. And that is incredible. They have the whole world using their platform, but if they can increase the profit, the amount that the amount of profit they make out of this huge chunk, because this is already enough. If they increase their profit margin, they would increase their profitability of their business. Just like a couple % increase in profit margin would take their earnings to a whole nother level. So that's just a little bit about that. We have to keep in mind that their profit margin is probably going to increase here in the future as they go more towards this web services thing. So they have a negative cash flow the last year of 14 billion, and that is because they're investing in now, a lot of infrastructure has been built, especially for the shipping and the logistics business, which they also have. They're investing in planes and drones and different automations, so like robots can deliver packages and stuff like that. And that will, in the future, of course, pay off. We don't know how much it will pay off, but that is a long-term investment. These things have to be built, and we have to look over the coming years to see. But one thing that we know is that Amazon is building a whole empire of logistics right now. They want to have the fastest shipping, the best shipping, and all these things, and they probably already have that, but they are really doubling down on this thing. So they are making a lot of investments, and that is why we can't really blame their cash flow going negative, because that is something that they are expected to make up for in the future. So the average 5-year free cash flow has been 11 billion, so they are in the green on that one. They have a incredibly low actually 5-year return on invested capital. That is 4.6. We would like to see that greater than 9%. So they are not at all good at generating returns on their investors' money. A little theory I have here is that return is going to come in the future when we see these logistics and infrastructure investments that they have been making pay off. But definitely the past 5 years that has been really, really low, and even lower the past year when we have had a negative 6% return on their investors in the capital invested in the business. Here in the income statement, we want to see that they are growing their numbers. So we go back 5 years and we look at their operating revenue, and we can see it was $177 billion. Last year it was 469 billion. Incredible growth there. That is like 2.5x right there. So incredible revenue growth, but their profit margin is what is holding them back. So also we want to see their shares outstanding either staying the same or decreasing. The reason for this is you don't want to be diluted as a shareholder. And that is basically when a company issues more shares, so your share gets worth less, it gets inflated. A little analogy for this is if there was a business that had 10 outstanding shares and you owned one of them, you would own 10% of the business. But if they went ahead and bought back 2 of those shares, you would still have your 1 share, but that share would now be 12.5% of the business. That way they just increased your ownership stake in the business without you having to do anything, not even pay taxes. So you can see 5 years ago they had 480 million shares. Now they have 506 million shares. That means they have been diluting us over the past 5 years. Like steadily over the past 5 years they've been diluting shareholders. That is not a good thing to see, guys. But because Amazon's shares are significantly overvalued right now, which we'll take a look at here with the stock analyzer tool in a bit, it is actually better for them to dilute shareholders and basically give them overvalued shares instead of taking on more debt. So you can see here they have around 100 billion. They have 96 billion in cash on hand, and they have 258 billion in long-term assets. And that just covers their total liabilities. For the cash flow, we want to see that increasing. We go back 5 years, it was $6.4 billion in cash flow, and last year they did negative 14.7 billion. If we look just above that, you can see the capital expenditures. You can see it went from, like in 2019, from 16 to 40 to last year 61 billion. And that is an insane amount of money that they spend, and they definitely don't buy back shares, which is one of the 5 things they can do. They don't pay out dividends, which was another thing that they could do. The thing that they're spending this cash flow on is actually just investing into the business with infrastructure and these logistics that they're building out right now. So that is what they're using the free cash flow for, and who knows if that is going to pay off. That is an uncertainty right there, which is also a risk factor. So if we go here to the 8 pillars, you can see that we have a lot of X's, and this is just, it's not looking good for Amazon right now. We can see that their 5-year PE is 104. We want that less than 22.5. We can see here that the 5-year return on invested capital is much less than 9. It is 4.6. They have grown their revenue over the past 5 years. They have grown their net income, and these are huge factors. They have actually like doubled or tripled these 2 metrics here. But their shares outstanding has went up with 6.7%. They've been diluting their shareholders. Their long-term liabilities divided by their 5-year free cash flow is much higher than 5. But again, these last 3 here has to do with the cash flow, right? And of course, the 5-year price to free cash flow is more than 20 when they're like spending all of their cash on all of their cash flow on investing back into the business. So I would say you can't really blame them for wanting to, invest into the future. That is something that they have to just do their thing with that. They've been pretty good at it in the past, so. Yeah, can't really blame them for that one. But yeah, here I already played around here with the stock analyzer tool, and these are like the most bullish assumptions that I could come up with myself. We'll take a look at Analysts Assumptions here in a bit. But basically, 10 years of analysis, we have low, mid, and high assumptions here. This is the historical data. And basically what I went ahead and did here was I popped in 13, 14, and 15 for the revenue growth. that is absolutely the highest that I would ever go. You know, I could go higher just for the fun and just to see what people are actually expecting at the current price, but this is absolutely the highest, because if you imagine, like right now they did like almost $500 billion last year in revenue, 15% growth of that every year for the next 10 years. And for the profit margin, I also went extremely bullish, because I think that Amazon Web Services will start to take a bigger share and be a bigger part of their revenue, and because that has a lot higher profit margins, that will be able to be seen on their balance sheet in form of earnings. So you can see the low estimate that I took was actually higher than what they've been doing the past 10 years. So I have been really bullish here. 7% is what they did last year for the profit margin, and I've went ahead and did 9%. Here for the free cash flow margin, I also went bullish, and for the price to earnings, I wouldn't go more than this. This is just crazy. I've never seen a company this big trade at a 50 price to earnings. So that is absolutely insane. These are reasonable price to earnings. Yeah, you have to think about if this company in 10 years does this growth, makes $1.5 trillion in revenue every year, probably going to be like a market cap of like at least 5-6 billion or something like that if they keep the price to sales, and 5-6 trillion if they keep this price to sales, right, that they're on right now. That means that like how much growth do they have ahead of themselves 10 years out, right, at that market cap. This is absolutely bullish for that reason. A high of 2,700, a mid of 1,800, and a low of 1,100. This is just overvalued right now. But let me show you analyst estimates here in a bit to kind of emphasize this, because there are 50 analysts that have made their predictions. In order for us to get green numbers here, let's put in 20 all over across the board here. Hit the analyze button. Boom, you have a green in the high. So if you believe these estimates, you have actually didn't have to go that high. So 18. Yeah, you have a buy, right? So if you believe these estimates for the next 10 years, then it's a buy. And then you will get a 12.5% annual return. Let me just show you here Analysts Assumptions here. So you can see here the EPS estimates from 50 analysts. And last year they did $64 per share in earnings, and this year they are forecasted to do 48, and that is because, you know, we haven't got this stay-at-home situation anymore. So now people are not just sitting online buying stuff all day. So this is the average from 50 analysts that sit all day. They maybe have 10 stocks that they have to put in estimates on. These estimates, when we are dealing with 50 analysts, they should be, you know, the most accurate you could probably get out there. So basically what this means is, if they were to stay at this price, so you wouldn't make any money for the next year, basically the price of Amazon would stay the same until the end of 2022. And let's say they do this average estimate here, then they would be trading at a 67 price to earnings ratio. That is an unheard of price to earnings ratio for a company this size. So let's just say that they actually have a reasonable price to earnings and they do these estimates. Still high for a company this big, but remember the 14, 18 and 16 I put in the stock analyzer tool, that was 10 years out in the future. So yeah, boom, you have a stock price like, you know, not even close to where we are at today. A lot of companies that I look at, you know, you see everything here green except the value indicators, which is these two here. But, you know, they're not even buying back their shares. They are not generating any like value. They're just investing it back into the business, which, you know, I kind of like that. But still, they're not generating returns on nice returns on the money invested. You know, I just look at it going, I don't see the value, guys. I don't see the value, and you might be mad at me for that. But please comment down below and tell me what is it that you see in this company that I can't see? What is it that all these well-known investors see that I don't see? Please go ahead and comment down below, because, yeah, quite frankly, I just don't understand this. But if you do want to see a company that I just bought and find great value in, then go ahead and watch this video right here. And yeah, with that said, have a great rest of your day. Peace out.